All right. Well, thanks everybody for joining in with us. Today we're talking about business planning. And, as always, we like to start with a story, right? And so um, over this last year and a half, a couple years, there's been all kinds of craziness that has happened in the world, a lot of situations that are very stressful. And I remember one of my clients that was trying to get on a cruise ship, and this was in January of 2020, right? So COVID had already started in China, and he had a layover in Hong Kong, and then he arrived in Singapore because that's where he was supposed to leave for his cruise. And when he got there, they wouldn't let him get on the cruise ship because he had had his layover in Hong Kong, and so he had to return to the United States. And one day later, one day after he left, there was a businessman from China that arrived for a business conference, and I guess that was the outbreak of COVID in Singapore. So if he would have been there one day later, they would not have let him get on the plane. They would have required that he stay there, right? He would have been stuck outside of the country. And at the time, this is a business owner. He owned a pharmacy. He had many employees that he had to manage, that he had to take care of, that he had to pay, that he had to, he had vendors, he had, ongoing business operations that he had to take care of. And he also had, he was in the middle of selling his business. And so, that's a big transaction. And he was trying to figure out all the details with his attorneys, his tax professionals, everything to make sure that could be finalized as well. So just imagine getting stuck outside of the US, getting stuck outside of your country for an extended period of time while you have to manage all of these things and not having any documents in place to be able to empower somebody else to do those things for you, right? So it's very important to have even just basic documents in place, particularly as a business owner. A lot of times when we talk about estate planning, or when we talk about planning for the future, we think of it mostly to protect our family. But when you're a business owner, it's not just your family that's relying on you. You have your employees that you have to worry about. You have your, whatever vendor relationships or other contacts that do business with you. They're relying on you as well, right? If you have a business partner, your business partners are relying on you, or your shareholders. If you have investors, your investors are relying on you. And so there's a lot of dependence on a business owner. And unfortunately, for whatever reason, business owners are notoriously bad at planning for the future, right? And so a lot of business owners, and you can't fault them, because they get into business and they're focused on, being able to make the business successful, operational, making money. That's what they should be focused on. But at the same time, there's a lot of the foundational things that kind of get overlooked or get skipped in that process. Why? Because it's a distraction, right? And so even though it may be important, it doesn't feel like it's urgent when you get started. So a lot of business owners, for example, sorry about that. The first thing that they do when they start their business is they'll register their business. Often they'll just do it on their own. And then they don't even know necessarily, how they registered it, why they registered it that way. Often they don't have, advice from tax professional or legal counsel advising them on how they should register their business. And so, they kind of take the path of least resistance. And as you grow your business, the bigger your business grows, the more important these decisions are, because they affect you more and more the more successful your business ends up being. And so, for example, the form that you select for your business influences everything from your taxes to your liability protection to the way that you're supposed to operate to, if you want to exit, how the exit is supposed to happen. And in the case of an emergency where a business owner is incapacitated, or when they die or something like that, it influences those sort of things as well. Most business owners, and I would love to say that that I'm an exception, but pretty much every business owner at the beginning, when they first start, these are not the things that they're thinking about. They're just thinking about getting things running and becoming successful, right? And so that's one of the reasons it's interesting. If any of you have read the E-Myth, it's a really good book. Talks about business startups and entrepreneurship. And one of the statistics that they share there is that in the first 2 years, statistically, close to 80% of businesses won't stay in business, right? They fail within the first 2 years. But the businesses that go in with a proper plan, with a proper structure, with a proper, goals and marketing plan and everything that, from the get-go, there's actually 80% success rate, which is a statistic that we don't hear about that often, right? And so planning is extremely important when it comes to being a business owner. And that planning can come, sure, I'll put it here in the chat. That planning can come in the form of financial planning. It could come in the form of legal planning. It could come in the form of, your business structure, tax planning. But every time that you spend time on planning, that's an important consideration, because it really makes a difference for the future of your business. So that book that I was mentioning, if you're interested in looking it up, it's called The E-Myth by the E-Myth, or the Entrepreneurial Myth, by Michael Gerber. So the other interesting statistic is that if you look at businesses that are successful, that actually have succeeded in business, they've been in business for a really long time, and whether they're family-owned businesses or not, within 2 generations, the drop-off rate of those businesses not succeeding in being transferred to the next generation or the next generation is tremendous. It's like 76% of businesses that are successful do not get transferred to the 3rd generation, because somewhere along the way something goes wrong. And most of the time it's because there was not a proper plan on how that's supposed to happen, how that transfer is supposed to take place. So what we're going to talk about today is we're going to talk about a few different aspects of business. And this chart here shows the phases that you have in business. So the first phase of business is the formation, or the startup phase. And while you're in that phase, basically what you're trying to accomplish is get up and running, right? Become successful, go to market, all those sort of startup issues. And there are planning considerations that should be considered when you start your business, and particularly deciding how you're going to form your business, how it's going to be registered, how you're going to operate, those sort of things, right? And then once your business starts growing, you get into the growth phase. That's when you're acquiring clients, you're getting contracts, you're operating, and so on and so forth. And you kind of get into a routine where you're actually growing in success. And obviously, when you're growing, there are other considerations that may be different, right? That are the priority. And then again, you get into an operation or maintenance phase. That's basically where the business kind of gets to a plateau, and now you're just maintaining that growth that you've developed over the years. You're servicing your client base, your user base, or whatever type of business you have, and you're just continuing to operate, right? But at some point, there's going to be a transfer of the business. And the transfer could be in a bunch of different ways. It could be a sale, right? It could be retirement. It could be passing it on to the next generation. It could come in a lot of different ways. But depending on where you are in business is going to determine some of the considerations that you want to think about for your business planning. And these are important things to make sure that you have in place, because it's going to really determine where you are when you hit the next phase of your business dealings. So let's start with the first one. The first one here is, and there's a typo on this slide, I apologize. But the first one on here is the form of business that you choose to start with and that you choose to operate under. So a lot of business owners, again, when they start, all they do is they say, okay, well, I need to be a business, so I'm going to register something. And oftentimes they just register a DBA, or they just start operating, right? And they come up with a name for their business, and then they just start operating. They don't even register anything. Sometimes people will register the business and they just kind of say, well, what should we be? I don't know. They pick one, right? So let's go through the different forms of business. The first one It's called, and it's a typo on here, I apologize, but it's called sole proprietorship. So when you start in business by yourself for yourself, if it's just you and you're operating your business and you haven't registered your business, you are a sole proprietorship. And under the eyes of the law, a sole proprietorship is an extension of you. So it's, again, you, yourself, and you. If you don't work, then there's no business, right? And so a sole proprietorship basically means that there's no official entity as a business. Even though you may have a business name, even though you may have a DBA, there's no entity that protects you or that separates your taxes from yourself personally. And so as you operate as a sole proprietorship, it's a very easy form to be able to start in business because it has very little requirements to be able to start in business, but it doesn't offer you any protection in the form of asset protection, right? It doesn't offer you any it doesn't offer you any tax benefits. It doesn't offer you any options for more advanced planning because it's just an extension of you. When you start in business and you have a partner, it's a very similar situation, but instead of being a sole proprietorship, you are a partnership. And a partnership can be very formal or it could be very informal, right? So in a partnership, generally speaking, you want to have a partnership agreement, which outlines the terms and the requirements and the expectations of each of the partners. But if you don't have a partnership agreement, then basically you still have an agreement. It's just a verbal agreement between you as partners. And the idea is that in a partnership, whoever the partners are making decisions together, but you're really just the same as a sole proprietorship for purposes of taxes. It just flows through to you personally, and there's no protection for the partnership outside of that agreement. So the idea of a partnership, again, is a very informal method to start your business, and it may be appropriate depending on the situation, but it also may leave you exposed to liability, to extra taxes, and so on and so forth. The first official form of business that you have to register, right, in order to have that separation between yourself and your business is what's known as an LLC. And this is the most flexible form of business. So an LLC is also known as a limited liability company. And the IRS doesn't recognize LLCs. It's not an entity on the federal level. It's only an entity on the state level. And so whatever state you're in will have laws that apply to LLCs. But the idea is that the limited liability company gives you protection and you get to choose how it's going to be taxed. So you actually get the option of being taxed as a partnership or being taxed as a corporation. When you structure your business, you want to make sure that you have everything in place to maintain what we call the corporate veil. And the corporate veil basically means that your company is separate from you and you're sheltered, you're shielded from any liability that comes through the company to you personally. You're also shielded in the company from any liability that comes to you personally that's not from the business, right? So there's a full separation between the business and you. And there are 3 ingredients that you have to maintain in order to have that protection. So those 3 ingredients are, number 1, you have to have the business registered in good standing with the state. For an LLC, that's very easy because all you have to do is make sure it's registered and that you keep the registration current. Number 2 is you have to have proper accounting practices. So when we say accounting practices, mostly we're talking about bookkeeping, right? So you need to make sure that all of your expenses in the business are legitimate business expenses, that they're not personal expenses that you're running through your business. And that any personal expenses you're keeping, in a separate account. So the easiest way to do this, especially for a small business, is to have a separate bank account for the business that everything goes through. And then you keep those records so that anytime that you need to pay yourself for something personal, you write out a check to your personal account and then spend it from there, right? That's the best way, the easiest way, especially for a small business to do that. So that's number 2. And then number 3 is your legal documents. Your legal documents will determine the extent of liability that can flow through to you. And it will also determine what the court's going to look for if they try to pierce the corporate veil to see whether you're actually operating as a business. So the basic core document that you want to have as an LLC is called an operating agreement. Your operating agreement outlines the terms between you and partners, if you have partners. It also outlines the method that the LLC is going to make decisions and going to manage the company. And your LLC or your operating agreement is also where you're going to include your business succession planning and some of those other considerations that we'll get to in a little while. So it's very important to have those 3 ingredients, because if you do have those 3 ingredients, then your business will be fully separated from you personally, and you will be able to avoid liability from anything that comes through the business, and your business will avoid liability from anything that comes from you. So that's very very important. And it's the same thing if you have a corporation. The corporation is a method to be able to, number one, owners of a corporation are called shareholders, right? And they own an interest, and they get paid based on how the corporation does in the form of what are called dividends. And so when you have a share in a corporation, depending on the profits that the corporation shows, those then can flow down to the shareholders as dividends. But it's not just a pass-through entity the way that a partnership would be, or a sole proprietorship. Again, your LLC could be one or the other. It could go either way, depending on how you choose to tax it with the IRS. So the reason that a lot of times, especially when your business starts becoming successful and you start making more money, that the corporation is a good option is because it can minimize the tax exposure that you have in your operations. The S corporation is very useful to avoid what we call self-employment taxes. So if you're a business owner, every time that you make money, there's a type of tax that we call self-employment taxes, but they're also called FICA taxes. And so, sorry, this is not writing that well. Okay, there it is. FICA taxes. FICA taxes are what include Social Security and Medicare and all of those expenses, right? And as an employer, you pay part of the FICA taxes for your employees. So if you're a W-2 income employee, your employer is paying part of your FICA taxes, and you're paying part of them in what you earn. But if you're a business owner, those FICA taxes come out of your earnings for the year. And as an LLC, partner taxed as a partnership, or as a partnership or a sole proprietorship, those FICA taxes basically are an additional 15% tax on top of your regular income taxes. And it's important to pay your fair share, to make sure that you're getting the benefits of Social Security and all those things, and building up your credits and so on for the future. But the problem is that it doesn't continue adding credits to your Social Security account or anything like that after a certain point. So after a certain point, it doesn't make sense to pay extra FICA taxes. And if you're making too much, then it's just an additional tax that you have to deal with, right? And so when you register as an S corporation, you're taxed as an S corporation. The idea is that those FICA taxes can be avoided on all of the dividend income. So you pay yourself a reasonable salary, and on your salary, you pay FICA taxes. You pay your self-employment taxes. But on everything else, you don't have to pay those taxes. And because of business deductions and everything else, it's very easy to avoid some of the taxes on your regular income. But on the self-employment income, it's a little bit harder to deduct and to be able to avoid all of those taxes. So once you start earning enough, the S corporation may be a good option. And then when you get to the point where you're earning substantially more, or when you have a CPA that knows what they're doing, that really understands how to do corporate taxation, then you would possibly want to consider a C corporation, because a C corporation opens up the doors for fringe benefit planning and for a lot of tax strategies that you don't have the availability to use in the other forms. It also can give you more credibility as a corporation, because it allows you to be publicly traded if you want to be. It allows you to be able to, basically tell people that you're a corporation, and that you operate as an Inc. and all that sort of stuff. And so, if it's important for those purposes, then it also may be important to consider being a C corporation. Some people are afraid of the C corporation because there's the possibility of double taxation. So what does that mean? Well, it means that the C corporation pays taxes for all the earnings, and then anything that is going to be paid out to you as a dividend holder you pay taxes on again, right? So it pays it on the corporate level, and then you pay it on the personal level. And that's the thing that scares most people. But if you have a good tax professional helping you, then it shouldn't scare you, because they can help you get around most of that, if not all of it. So that's some of the considerations related to choosing your form of business. And it's important to make sure that you're structured properly and that you're complying with those requirements. By the way, there are additional requirements to keep your registration in good standing with the C corporation and S corporation, because in addition to registering with the state, you also have to have an annual shareholders meeting. You have to keep minutes. You have to do a few maintenance requirements to be able to maintain those protections. But a lot of business owners never get to this point where they make these decisions. They're important decisions, right? Wouldn't you agree? And so at the end of the day, these are some of the things, especially in the formation phase, that's important to consider for a business. And even if you've been operating for a while, your business may have changed. It may have grown. It may have evolved. And maybe you need to consider a different form of business. So meet with competent legal counsel, tax counsel, to advise you on what would be the best fit for your company. The next thing we want to talk about is in relation to business succession planning, planning for the future, planning for emergencies. As a business owner, like we talked about, there's so many people relying on you for the business to be successful that it would be it'd be a shame if something did happen to a business owner that was unprepared, right? And I'll share two examples with you guys. One example, we had somebody who contacted us, and unfortunately this was after the fact, but there was a business owner who had a business that was worth $12 million. It was successful, it was growing, everything was going well. He had gone through a very difficult divorce, and so he was worried about making sure that now that he was divorced, that his children were going to be taken care of by his family, because his ex was a little crazy, and that she didn't have access to the money. But he didn't do anything in terms of estate planning or putting documents in place, right? And so he ended up having an accident and passed away unexpectedly. Who's going to be the guardian for the kids? Well, their mother's going to be the guardian. So she was, taking control of that. And since he didn't have any documents, she was in control of all the money. But because he hadn't revised his corporate documents, she also became in charge of his company. And she didn't know how to run a company. So she didn't know what to do. She didn't know how to do it. She didn't want to sell it because she thought that it was valuable. She wanted to run it, and she ran it into the ground, right? He didn't have any business partners to be able to kind of step in and avoid things. And so it was a very sad situation. These sort of emergency crisis situations can happen to anybody. And if you have a proper business succession plan, then you'll avoid the worst of it for your business, for your employees, for your staff, for your partners, and for your clients, right? Because, we, as businesses, we do a service for people as well. That's why they pay us, right? And they rely on us. And so it's important to have a proper plan to plan around some of these considerations. And we call them the 5 Ds of business succession planning. So the 5 Ds are, you'll see them on here, death, disability. We say dementia, but it could be any form of incapacity, divorce, and dissolution. When you go into business, or if you're already in business, if you don't have a proper plan to address these things, you should have documents that say what's going to happen to the business if one of the partners dies, if one of the partners becomes incapacitated, if somebody goes through a divorce, what happens to the business? And we want to, keep the control of the business where it's going to make the most sense for the business to be operational, for it to be successful, for it to be able to continue running properly, to maintain its value, and so on and so forth. But we also want to make sure that we're protecting that value in any way that we can. So oftentimes that includes insurance. When we put a buy-sell agreement in place, for example, between partners, if one of the partners dies, the money to purchase the business from that partner's family can come in the form of life insurance. It's a very easy way to be able to leverage that money to be able to pay for the buyout. Same thing with a disability plan. We had a group of chiropractors. There were 4 partners. One of the chiropractors became incapacitated because he was injured. He became incapacitated because of the injury. He wasn't able to continue working. So for 3 years, and this was because they didn't have a proper plan in place, but for 3 years, he was continuing to collect profits as a partner of the business, but he wasn't able to work, so he wasn't contributing to the business. So the other 3 partners who were very profitable, who were handling their clients, who were growing the business, they were basically carrying his weight. And they didn't have a way to get out. And finally, they got fed up with it, and so they started the process of meeting with us to help them to negotiate the purchase of his interest. But without a proper document in place, what happens is that you could have a partner that stops being a partner, stops helping, stops contributing, stops being part of the decision-making process or part of management, and they keep making money from you because you didn't have anything in writing, right? And this can happen in a variety of ways. We've had business owners that have been charged with criminal actions, rightfully or wrongfully, and they've end up in jail. And while they're in jail, nobody can get access to their bank accounts, right? Because maybe they're not on the bank account, so they don't have permission. Nobody can manage some of those things that are necessary that come up while they're in jail, right? Or maybe you're in the hospital, maybe you're in a coma, same sort of situation. Maybe, we've had situations where the business owner has a lawsuit against them, and because they didn't structure themselves properly, it affects the operations of everybody, right? And the other partners have to pivot and so on. Or if you travel and again, you get stuck outside of the country or something like that. And so your business succession plan should address these 5 Ds, and 3 out of the 5 can also be addressed by using insurance to be able to leverage funds to address the risk of these occurrences happening, right? If you go through a divorce, again, it's important to make sure, because one of the nightmares that many business owners have is being in business with your partner's ex-spouse, having to be in business with them, right? So we had another client that we were talking with. He owns many franchise restaurants, and he was selling 3 of them. And I asked him, well, why are you selling? They seem like they're doing well, they're making money. He's like, yeah, I love it. I would keep them if I could, but I've been in business with my ex-wife for the last 10 years and I'm sick of it. So I'm selling them because I need to get away from her. He didn't have a way to be able to separate himself in business. And so he continued as a business partner with his ex for 10 years before he could finally, sell the businesses and get out from under that. And then finally, sometimes business partners need to go their separate ways. They have, differences of opinion, or the businesses just, dissolve for whatever reason. And your business structure and your corporate documents should address what happens at that point. So as a business owner, it's important to plan for the future, right? And a lot of business owners, especially, business owners who, the average business owner, usually doesn't really plan for the future. They don't save for retirement. A lot of times we expect that our business is going to be our retirement plan, right? And someday we're going to sell the business and then we're going to cash out and everything's going to be good. But think about this. If you were a restaurant owner and you had a booming restaurant, and then you were getting ready to retire, and that was in 2020 when COVID hits, what kind of a exit are you going to have in your business? Is there anybody who's going to pay you top dollar for your restaurant when everything closes down, right? We don't know when these things are going to happen. So if we rely too much on any one strategy, and especially on just having the value in the business, there's so many things that could go wrong, and then you have nothing. And so planning for a successful retirement, planning for a successful exit, planning for the being able to retain key employees. That's another thing that's important, is making sure that your benefits programs are in line with being able to attract talent and retain it. Because we've seen it time and time again where there's maybe a key employee that without them the business couldn't operate, and then they get poached. Early on in my career, I started working with a law firm that did foreclosure litigation, and I was working with them for quite a while. And they had one office manager that ran everything. She was the only one that knew how to run everything. And then she left. She got hired by another company. So what happens to the business? Profits go down, operations go down, and you have to try to scramble to replace that. There are ways to address that sort of planning with proper financial tools, legal tools, and so on, right? And then finally, as a business owner, what kind of a legacy do you want to leave in business? Are you considering how you do business, and is that going to continue when you're no longer there to operate it? Because those are the things that make a difference, that make a business successful. And it's important to consider that as part of your overall planning. So with that, we're going to go ahead and wrap this up, and then I'm going to open it up for some question and answer. Thanks for joining us.